Oh, what is going on YouTube? Today we got an economic video. We're going to be talking about the major events that have happened this week, the major events that are happening next week, their implications for broad equity markets, and more importantly, what that means for cryptocurrency. So hit the like button, subscribe, show some support. I really appreciate it. And yeah, we can get right in. But actually, wait, before we get started, scan this QR code with your phone and you'll get some free PCC. Let's dive in. So, jumping right into the charts, Bitcoin, a bit of a consolidation, more than I wanted to, right? We were watching this higher low, and now we're consolidating around 28K. I think we're going to get a big move to the upside or to the downside. Which direction? Who really knows? Personally, I'm bullish here. I do think we're going to be trending above 30K. SPY not really making that clear impulse move towards 4,200. Kind of understandable because we got employment data that shows the labor market is weakening. Part of the reason why I think SPY is lagging compared to NASDAQ is because the SPY includes much more bank stocks, which are obviously hurting. And that we're seeing that equity rotate into risk-on assets, hence why NASDAQ broke market structure and is in price discovery. Overall, VIX still trading at a discount, I think, right? The anticipated volatility over the next 30 days. The key thing I want to talk about before we dive into the news of the economy is Dixie, DXY. So we've really broken a key level here, and I think if we get a weekly close around 101, that is confirmation that we are going to be trending below and make a lower high. So overall, US dollar currency index is not looking good, but that is really good for people who hold assets. So all in all, just a quick talk on silver. Right, it is in price discovery. It's on a year high. Gold really close to all-time high. So I think people are starting to look at commodities as a more or less safe haven. Maybe they know something we don't. Giga crash? Who knows? So the major economic event that kind of provided some turbulence today was the JOLT job openings report. It came in quite a bit cooler than expected, and that tells us that the labor market is starting to weaken. So just reading a CNBC headline, job openings tumbled below 10 million in February for the first time in nearly 2 years. So these are the number of positions that are added to the U.S. economy every month. Basically, part of the reason why inflation is so bad, there's two components to inflation. There's demand and there's productivity. There's demand and there's the labor market. So they've done a pretty good job quelling demand because demand is a function of interest rates and debt and credit accessibility, which obviously they change with interest rates, right? Conversely, the labor market is much harder to hit because it has to filter through the business ecosystem before people actually start getting laid off, before there's less job openings. And so the Federal Reserve has said time and time again that they need to see the labor market weaken to justify either a pause or a hold. So I'm just going to read this quote here. The labor market is starting to loosen as the number of jobs opening declined in most sectors. As the economy slows, firms will likely cut openings and workers will be less likely to quit in search of better hours and higher pay. The Fed could consider pausing hikes at the next meeting, but only if the upcoming employment report shows material weakness and the March CPI reveals lower inflation. So that begs the question, when is the next CPI? So this week, the only other major economic big ticket items that I'm paying attention to is Thursday and Friday. Thursday, we get jobless claims. Friday, we get the unemployment report. And so just like your stupid friend on a Tuesday morning climbing a mountain, somebody's going to be unemployed. Unfortunately, if you noticed, when Jay Powell was sitting in front of the senile old people on Capitol Hill, they were roasting him about how people had to lose jobs in order for inflation to go down. Fuck, man, those people are so stupid. They just don't get it. Anyways, so Thursday and Friday, I'm expecting some volatility because the market is looking for more information as to if the Fed will pivot. Next week, Wednesday is the big day where we get CPI and core CPI, and then Thursday we also get PPI. I googled it here, pretty cringe. Producer Price Index. It's basically the inflation for business side production. On that Thursday, we also get more jobless claims. So a bit of a sleepy week for economic fundamentals. This week, Thursday, Friday, it picks up. And next week, we are back to economic watching. It's like whale watching, but for neckbeards. Think about it. So with this in mind, one of the ways that we can track how the market is reacting is with the CME FedWatch tool. So the next FOMC where they're going to change interest rates is officially 1 month out. It will be in May. And so right now, the current interest rate is 4.75 to 5%. And the majority of the market thinks that this is the statistically likely option, coming at 61.6%, while the minority of the market thinks we're going to get a 25 basis point hike. But using this handy dandy tool up here, we can try and forecast, or the market can forecast or anticipate what rates will be at different meetings. So if we look at the last meeting of the year, December 13th, 2023, the statistically likely option is actually 75 basis points lower than we are currently. It is between 4% and 4.25%. So that means the market is starting to anticipate rate cuts from the Federal Reserve, and we all know what happens after rates start to get cut. The economy crashes, things break. And so in the context that they are starting to restart QE to support these banks, we are starting to see the labor market start to break. I personally think there is a very limited window where we are going to see a melt up before we see everything melt down. I do think we do have a bit of time to run on risk on assets like SPY, NASDAQ, crypto, because the next FOMC is a month away. But ultimately, I think we have maybe 1 to 3 month window. I've been calling it DeFi summer, but hey, I think this is not the time to get super greedy if you haven't already positioned, because the downside at the current price level seems higher than the upside, right? So if you were buying stocks when the SPY was trading 3,600, you're laughing, you're sitting pretty. But if you're buying stocks when the SPY is at 4,100, I mean, your upside to all-time high is what, 17%? And your downside to the recent low, if I can click my buttons appropriately, is 15%. So higher risk buying at these prices, I would exercise caution. But again, this is financial analysis and not advice. So just to summarize, end of the week, we are getting more labor market indicators. That is going to provide some volatility. Next week, we're getting more inflation markers as well as labor market indicators. So that means all eyes are back on the Fed. If you haven't already, I recommend watching this YouTube video. It will provide some context to my current thesis if you haven't already seen it. Thank you for watching. Stay safe. Take care.